I find that to be actually one of the biggest challenges within the space in general. But so within the metrics that I'm looking at, I'm looking for demographics. Like you said, I'm looking to see what's the median income of that household in the 1, 3, and 5 mile radius. I also like to ask, where do people go when they leave this property?
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, this is Augustino. As you build out your real estate syndication business, creating the right relationships and helping others succeed are absolutely key. By building that team that can support each other, you can surround yourself with like-minded, strong individuals that are all in it to win it. Well, today's guest had to do just that. Early on, she and her partner had to build up a large portfolio of single-family homes when they realized they hit a scalability ceiling. So they decided to jump into multifamily syndication. Fast forward a few years, the company that she co-founded in 2015, Enzo Multifamily, is rapidly growing to the sense that now she has created her own company, Vive Funds. And her previous business had acquired 2,500 units valued at $350 million. Now, to do all this, she applied her 10 plus years of experience, including overseeing management of $1 billion in real estate assets. Now, today, she serves as her own chief investment officer at her own company at Vive Funds, where she is responsible for acquisitions, syndications, growth strategies for all of her multifamily assets. With all that, I'd like to welcome my good friend, Veena Jetti, to the show. Hey, Veena, thanks for coming on.
Hi, thanks for having me. Excited to be here.
Yeah, it's going to be great. Well, if you like what Veena has to say, you can reach her via her website at vivefunds.com. And if you like our content, please don't forget to leave a comment and rate the show. And finally, if you text the word freedom to 202-410-4202, you'll get our free ebook, The Bulletproof Guide to Finding a Broker. Okay, Veena, go ahead and tell listeners a little bit more about your background and how you got started.
Yeah. So, like you said, I started probably pretty similarly to most people in multifamily, where I started in a single family portfolio and then eventually scalability becomes an issue. I always say I kind of took the shortcut into real estate though, because I come from a real estate family. So my mom actually was an avid real estate investor over the last 30 something years. And so I had the fast track in, if you will. I kind of knew what real estate was from a young age. I understood how it worked. I kind of, learned alongside my parents as they were learning and building this foundation. They're immigrants, and they really built that solid foundation for me to be able to kind of take it to the next level. I graduated college when I was 20 years old. So I, was okay, well, now what do I do? And, it was work with the family business or go out into the real world and get a job. Ultimately, I ended up in the corporate real estate world, which was an interesting experience because it was 2007, 2008, 2009. And, I don't know who thought it was a good idea to give a 20-something-year-old $250 million at that time in assets, but I thought every asset was my own baby. I would stay up at night, how are we going to make this work? And, it was an interesting start in the corporate world. So I've been through the down markets, and then ultimately I ended up leaving my corporate gig to launch my own company, where I started with single family homes. And then, like you said, I met my partner, Seven, who had also kind of done the same thing in his own portfolio. And we had reached that scalability issue. And ultimately we kind of launched into multifamily, and here we are today.
Excellent. Excellent. Now, before we go into your background, it's interesting. So your family had done single family before. And so from the time you were very young, they were really showing you the business. So it was all single family back then too?
Yeah, so it was all single family back then. And it's actually really funny because for the longest time, I lived in this bubble where I didn't realize that this wasn't normal. And so I always think about this one story. I had a friend who reached out to me when I was maybe 25-ish. And she reached out to me and she's like, hey, my spouse and I are closing on a property. What should we expect at closing? I'm like, oh, well, it'll be like every other closing you've gone to, you go, you sign, blah, 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 blah. And she's like, I've never been to a closing. I'm like, oh, well, yeah, I know this is your first house, but when your parents would go to closings. She's like, my parents have never owned a home. And I was like, what? She's like, yeah, I've never had this experience. And so, yeah, I always say, I grew up with this idea, when my parents would take us to walkthroughs on the weekends, and we'd go to inspections, and we'd go to the lawyer's office. It was just normal for us.
That's
And
awesome.
so, yeah, so that was just like, kind of in my background.
Yeah, that's amazing stuff. I mean, because for many people, many real estate entrepreneurs that might be listening, one of the things I always like to do is introduce their kids
Hmm.
to the business, right? So it sounds like that's exactly what happened to you.
Yeah.
That's amazing. That's great
Yeah.
stuff. That's
Yeah.
super. Super. So fast forward. So you got into the whole multifamily thing. So you did the whole scaling up in the single family, and So aside from the issues with scaling the single family
Hmm.
portfolio, tell us about that first multifamily deal. How was it a tough deal to get into at first, or was it was easier than you thought it would be because of your experience?
It was easier because of my experience, but it was hard. So the first time I ever raised capital was actually not on a multifamily deal. It was actually on a development deal. And so I was going into development, which I didn't have a whole lot of experience in specifically, like beyond kind of the minimal exposure I had at my corporate gigs. So I think that was actually the hardest deal. I think the first deal where you're raising money is always the hardest because you don't really have like a proven track record.
Mm,
For me, it was a little bit easier because I had, my family's background, and then I also had my corporate background as well. So, and obviously my private portfolio, but that's actually what helped me. So I think like when you're starting your first deal or you're doing your first deal, the best way to kind of go about that is you need to partner with somebody who has the resume and the track record and let them control the deal, or at least have the ability to control the deal. Because then what'll happen is it'll give you the same credibility. You can borrow someone like my resume, right, to get into your first deal.
that's right. That's right. And I think that there's always this thing. Oh, I don't want to give up any of the GP, or I don't want to give up any bit of the general partnership. But at the same time too, it's like, listen, you're getting acclimated with an experienced person. It's okay to give them half the pie. Who cares?
Absolutely. I mean, look, I would do that 100 times over because it's like, would you rather have a small piece of a really big pie or all of a very small pie? And that's the $1 million question right there. And I think that's what allows you to be able to scale quicker, is being able to make these decisions that are in your long-term interest, even though it might not suit you for the short term.
That's right. And I think part of it is that the same way your approach was, is that you're building this into a business. This is not just a
Mhm.
one-off type scenario. And
No.
that's an entirely different thing. So in your case, now that you're still working with Enzo,
Mhm.
Enzo Multifamily, but now you have your own business now. Tell us a little bit about that spinoff and what you're doing these days with this new business.
Yeah. So when Enzo started, we had a very specific set of goals and kind of milestones that we were always trying to achieve. Ultimately, I think COVID kind of changed everything for everybody. All of us partners kind of had a shift in where we wanted to be, where we want to spend our time, how we want to do things, whether we should be acquiring, which markets we should be acquiring in. And I mean, honestly, I built something really special and really amazing with my partners. And I'm so grateful for that experience because I've learned so much from them and grown from that. But what we found was happening is we were getting to these points where there were deals that some of us wanted to do, some of us didn't want to do. Someone wanted to be on vacation, someone couldn't be on vacation. And it became very difficult to try to manage all of those differing like goals and different alignment, if you will. And so we were thinking about how do we restructure this, or what do we do going forward so that we don't hinder a partner. Because like I never want to hold one of my partners back. I want them to do well and I want them to flourish and succeed, because I take some ownership in that, right? Because just as much as I've learned from them, I think they've learned from me. And so one of the best solutions we kind of came up with was for us to be able to operate going forward in more of a JV structure. So that means if I don't want to do 123 Main Street in July because I want to go on vacation with my family. Well, okay, no one's going on vacation right now, but you know what I'm saying. And so I have more
Yeah.
control over what I'm doing. Or if, my partner says, you know what, like I really want to go into, the Boise, Idaho market. And I'm like, I don't really know about that market. I don't have to do that. And so it just makes it a lot easier to control what we're putting our name on. For me, specifically within Vive, one of my goals and one of the things like I'm really passionate about is in Enzo, I was doing this too, but I now have full control over processes. So I'm actually creating a company that is very investor centric. So what that means is we have processes, and I have different systems that I've developed at Enzo, which I think work really well within the Enzo model. But now I'm going to take that and kind of take that to the next level so that it's just a better user experience for my investors. I'm going to correct some of the shortfalls that I felt we had within Enzo, and kind of make those and polish those up a little bit.
Yeah, well, that's a good thing. When you're able to rebuild everything all over again, you kind of like, I wouldn't do that mistake again, or I wouldn't do that thing again. You get to correct all those errors. Absolutely.
Exactly. Yeah. There's a lot of processes. And there's a lot of processes, quite honestly, like we just didn't have time for within Enzo, that I always wanted to implement because I think they'd be nice to have. I think it builds a business and it allows me to kind of step back as an investor. My idea for like my vision for the long term has always been to eventually kind of move to more of an advisory and strategic position versus someone who's like a slave to my business, if you will.
Right. So for the time being, though, you're still looking at deals, you're still looking at acquisitions, you're still running that side of things. So let's talk acquisitions now. I know you love doing that. I love looking at deals. I love studying markets and all that sort of thing. It's beautiful. So what are some of the things that you're looking for when you're assessing, like say a deal, like say maybe it's in a deal that in a market that you're not too familiar with? I'm not sure how many of those you're doing these days. But can you talk a little bit to that?
Yeah. So I actually almost never do a deal in a market I don't know about, mainly because I want to know my market better than anybody else knows my market. And that's just very much in line with my personality. I am somebody who, when I have a deal, you will never know more about my deal than I will, like ever, because I want to be able to answer questions. And if I don't know something about my deal that that's a problem for me. And so I'm always trying to absorb as much information as I can about the market. Pre-COVID, I was on the ground in our markets at least on a monthly basis, if not more often. There are times where I have literally been like in the Uber to the airport booking my flight so that I can get out there to see a deal. And so I'm not really going into any new markets. Every market that I'm entering right now is one of two things. It's either a market that I've been looking at and studying on my own or internally for at least like 12 to 18 months, preferably closer to like 18 months to 24 months. So we look at markets very, very closely for a very long time and make sure we understand them before we move forward into them. The second way we would go into a new market is with a very strong partner. So for example, if I was going to go into Ohio, I wouldn't do it on my own. I would partner with somebody like you who already has the teams in place. You have an understanding, you understand that market, you know how to operate in that market and thrive in that market. So those are the two situations in which I enter new markets.
Got it. So when you are looking at a deal, then what are some of the key things that you're looking at?
Yeah, so it's interesting because I think we're seeing a lot of change in strategy in the recent months, and it's a big change in strategy. It's not like, 2, 3, 4 years ago, you're maybe looking at a 8% pref was probably pretty standard on most deals. Today, I think you are probably going into a C or D class asset if you're getting that high of a pref. Or I think that you've missed something in your underwriting because the market just doesn't support that anymore. I don't care how good of an operator you are, it's just not supporting that. It's like a very, very one-off situation that happens. And so the key metrics that I'm looking for when I go into a market is I'm looking for those bread and butter assets. I've started shifting strategy a little bit more toward the more stable assets, I'll say. And, I say that loosely because we go into B-class assets that are fairly stable, but we're going for those maybe lower yield assets now where maybe we're not going to hit like a 15% IRR, but we're going to hit like a 13% IRR. And I can live with that because it's a risk-adjusted return. I'm looking a lot more now for opportunities for like management plays where there's inefficiencies in the operating expenses, not so much the deep lift, like the heavy value adds. I'm looking for places, if I could wave a magic wand and have somewhere where there's some rehab component, but it doesn't necessarily require the rehab component to bring it up to market. I have a property in Jacksonville that's very much like that. I'm raising rents by $200 and I don't have to put $1 into the interior. It's awesome.
Those are my favorite deals.
Yeah, it's like, so, if I could wave a wand, that's what I would do every time.
Right.
The market doesn't work like that. Every now and then you strike gold, right? But those are the things like I'm mostly looking for. I'm looking for those solid deals that I feel are going to protect principal, number one. Number two, they're going to give us some nice tax advantage K1s. We utilize cost segregation and everything across our portfolio. And so those are really like the main things I look for. And then I start looking at kind of what the returns look like. And then, obviously, again, risk adjusted return. It's a great catchphrase. It catches like all of the explanation of why one deal maybe makes more sense than another deal based on your personal portfolio.
Yeah. Well, but it makes total sense though, too. I think that the more experience you get in this business, the more you realize that you want to be playing in the B space anyway, and the B class asset. Mm-hmm. The C class stuff's I mean, depending on how the asset is run, depending on the management team. For instance, I have a great management team. They're super at running C class assets. That they can run that stuff like nobody's business.
Right.
To run an A class or even a B plus,
totally different.
I don't know if they could do it.
Yeah.
Maybe.
It's totally different. I mean, and that's what it is. And I think that oftentimes, and you probably see this too, people go into real estate and they're like, okay, I'm doing this and I'm buying notes and I'm doing fix and flips and I'm doing rehabs. And it's like, stop. There's like 100 different ways to make money in real estate. Pick one and be really good at it.
100%. You got to focus on it. Yeah. You got to focus on that one thing. And in our case, multifamily is what we do. And we focus similar story. We started off in the C class assets. We're getting into the Bs, and actually we're doing a new development in an A class asset as well. And we're looking at doing a second and possibly a third deal already backing up behind this one. So we're staying super busy with that, but it's the same sort of thing. I think that to your point, when you're getting into that B class asset, that risk adjusted asset, and meaning that the risk is reduced because the tenant base is a little more stable. Exactly. They're not so much worried about if they're going to have a job tomorrow. They're typically going to be middle managers. They're going to have some savings. Maybe they have a family. So they have a little more responsibility, that kind of thing. So, but nothing wrong with starting off in a C class asset. But I still recommend stay out of the Ds, stay away from all that.
I will say though, I try not to buy any more single family homes. And I say that because I'm like going to look at a single family house this afternoon that I'm probably going to buy. It's a totally different story, but I have one D class asset in my portfolio still, like my personal portfolio. And it is hands down my best returning asset, best performing asset. But I've seen the property exactly one time. I'm never going back there.
Right. And the thing is, though, is that I imagine you underwrote the tenant too, right? I mean, so that's a key thing. I mean, sure, you can do a D class asset, but that tenant better stay there for a long time, and you have to make sure that you are 100% right that it's not some bad person that's going to tear your place up. I mean, it's crazy. I couldn't even get insurance on it when I first bought it because they're like, State Farm was like, we don't insure buildings like this. And I was like, oh, okay. So now what? Ultimately, they were like, okay, you have to make these changes. You have to I had to take there were safety bars on the windows. Like that's when you're in a D class asset. And so, I took those off. I installed the smoke alarms, blah, blah, blah. And then they wouldn't even insure it for the price I bought it for because I bought it so cheap. They made me insure it for more than I paid for it. So. Right. But hey, listen, if you know what you're doing, I think in your case, though, your family has decades of experience with multifamily. So for you to make that choice is actually pretty easy. I would personally never do that.
I don't recommend doing it again. It was one of those things I could have really gone the other way too, because and that's why it's a risk adjusted return. I need the higher return to justify the amount of loss I could potentially be taking.
That's right. So aside from some of the stuff you just described in terms of the asset itself, what other aspects as far as data and other things that you're looking at to determine if you want to be in that area, maybe demographics or maybe even what websites you might be looking at?
Yeah. So we do a lot of data gathering in any deal we go into because data, I find actually that's the biggest weakness in real estate is the lack of instant data, and the feedback loops are very long. So by the time I get all of this data, like disaggregated data together in one place, it's like almost outdated because things are moving so quickly. Rents are changing in my comps every week. And so I find that to be actually one of the biggest challenges within the space in general. But so within the metrics that I'm looking at, I'm looking for demographics. Like you said, I'm looking to see what's the median income of that household in the 1, 3, and 5 mile radius. I also like to ask, where do people go when they leave this property? I want to hear that they're buying a house. I want to hear they're relocating for like another job somewhere outside of the area. What I don't want to hear is they're going to the neighbor property down the street, or they couldn't pay their rent, so they're being evicted. Like, those are things that are warning signs for me, if you will. Whereas if this is the last stop when they're buying a house, it tells me, okay, they're saving up, they're probably pretty credit worthy. And that's going to be the general database that you have of tenants there. And so that's what I like to see in terms of like the tenant base. As far as location goes, I like being in states that, I like no income tax states. So that's why I like Texas and Florida. That does not mean I will not invest in other states. My family's portfolio was in the Chicago markets. We're now completely divested, and we're only in the Texas and Florida multifamily markets as my whole family. And so I like those, the tax advantage states. I also like areas where there is a lot of diversity within the employment base. And what I mean by that is Fargo, North Dakota, there was that massive oil boom, and housing prices increased by like 400 and something % overnight. And I think a lot of investors went into there because it was an opportunity to make money very quickly. But the challenge that I see is, look what's happening to the price of oil right now. Now, what do? You have all of your tenant base or all of your market share depending on one field. And it's not to say you can't make money in those markets, because you can make money anywhere you are. It's just your model has to be such that you're going into that kind of a market. For me, I personally like diversity, which is one of the things I love about Dallas. It's one of the things I love about the Florida markets we're in, Jacksonville and Orlando. I like Tampa as a market. All of them, if you look at them, they have very diverse headquarters there. They're growing. Companies are moving into those areas. They're areas where we're seeing a lot of influx. So we look at how many residents move in and out of the state every year. All those are data points that we take into consideration. We're always trying to stay ahead of where businesses are moving. Like the Amazon announcement was like a really, really big one. I have DC properties. Now they canceled that, so that's changed again. But areas like that, I like DC because even though it's expensive and it's almost more like an LA type market or a San Francisco type market where you're not really getting as much cash flow, you're getting more of the appreciation value. I like it because the government is pretty much always going to make sure the government stays funded. So there's always going to be dollars moving in and out of that DMV area. And so that's why I like that area specifically. So there's different reasons to look at each market, but I definitely look at why those markets are doing well.
Yeah. So once you select a market, and I imagine you're probably looking at all the same websites everybody else is looking at, city data and
LoopNet and
CoStar. Same usual suspects. But sometimes I think, like you pointed out, that data is not always accurate, right? So
no.
It's at that point you probably get in your car and drive over there and you see what is actually going on there, right? Is there a certain sensation? Is there a certain feeling that you're looking for when you first walk a property?
No. I know you want me to say yes.
No, I'm just asking because
look,
that's my thing. That's what I got. I got the spidey sense going on. I walk on a property. If I don't feel it, I'm not buying it. So that's me.
No, I mean, I think one of the challenges is when people get emotional about real estate. I think it can be a really big challenge to overcome, right? And I'm like not even a little bit emotional about real estate like ever, because I grew up like this. I grew up where my parents, we moved to one of our houses every 2 years. We moved into a new house so that when they sold it, they didn't have to pay the capital gains tax, or they had the exclusion up to whatever, 500,000. And so I never really was attached to the houses that we lived in. We just moved to the next house, and they were all within the same area. So we were in the same schools and same friends. It was just, we're in a different house every 2 years. And so I think it just has made me like not really emotionally attached to real estate. Cause I tell my husband all the time, I'm like, yeah, I could sell the house we live in for the right price. Sure. Knock on my door and give me an offer. I'll move. And he would never sell this house. Like, he loves our house. It's home. He's a homebody. He grew up in the same house his whole life. So for him, like, he's never moving. But for me, I'm like, sure, make me the right offer. I can move. I have a price.
Hire movers. They'll move all that stuff for you.
Exactly. If you give me the right price, I can have my movers come. It'll be great.
Yeah. Excellent. Excellent. So now, if you can give your 19-year-old self a word of advice, what would you tell her?
Oh gosh, what would I tell her? Oh, I was in college still when I was 19. I was getting ready to graduate. I probably would have tried to get more real world experience in college still. Now, I did a lot of internships. I worked at a lot of major financial firms. Like, I worked at Smith Barney. My first job ever was in UBS, or it was Payne Weber at the time. Now it's UBS. So, I've worked at a lot of the big financial firms. I worked at Wachovia. But I think I would have tried to be more in the real estate space. I didn't realize I was actually going to love it as much as I do, mainly because, it's like, okay, it's my family's business. I want to not do that. So I never thought I would actually end up being in the same business. And yeah, here I am. And I think I would have probably tried to be more hands-on with someone else's deals, because I think that was really valuable experience for me, because I felt the pressure and I felt it as if it were my own money, but like, it really wasn't at the end of the day. And so I got to learn a lot on somebody else's dime. And I think that was very valuable. And I think, like, especially now dealing with this uncertainty, it's unprecedented, right? Like, none of us know what's going to happen. None of us have been through this before. But I feel like if you've been through downturned markets and you've gotten through that, it's almost the same in that your solutions aren't going to be the same, but you're going to be like nimble and you're going to be flexible in the same way that you were in the last downturn.
Absolutely. I mean, I think what you have to realize, for the listener out there, you already know this, that there's opportunities out there. I mean, there's a deal that I looked at just before we started our interview, and there was going to be a hotel deal. Now they're getting out of it. Now they just want to unload this whole redevelopment project, and here we are, and we're probably going to pick it up for a good deal. It'll be a good deal if we're able to get it. Yeah. So, perfect example. It's every market brings an opportunity. You just have to be ready for it. That's exactly the key.
That's exactly it. Yeah. And so, like, spaces like that, like, I love other real estate spaces. Like, I love the assisted living space. I don't have the time or bandwidth to be really great at it, so I invest with friends or other operators who that's all they do. So if I was going to invest in hotels, I'd invest with somebody like you, who that's all you're going to do. And so that's kind of where I would go with, if you want to be more diversified, be a passive investor on those deals.
That's right. That's right. And even learn from them too. You can still learn from them. Absolutely. Mm-hmm. Yeah. That's great. Great. Yeah. All right, guys. Well, if you want to reach out to Veena, you can reach her through her website at vivefunds.com. I hope you're able to understand that. Of course, building a great team is very important, but doing the right underwriting and understanding the market you're getting into is absolutely huge. Thanks for tuning in, and I will see you in the next episode.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.